Hey there, and welcome back to the Property Punch podcast, the show where we mix all things property into one sippable, easy drink. I'm Thabo, your curious host.
I'm Washington, your property and wealth mentor here at your Wealth Mentor. I'm here to keep things simple and practical.
Today, we're going back to basics. No fluff, no jargon. Just the essential words you must know to invest with confidence in Australia.
If you ever nodded along to someone at a barbecue where they're talking about big words like LVR or negative gearing, then this podcast is for you today.
That's exactly right, Dad. If you've ever been anywhere, a barbecue, out to coffee, for example, and you've heard people use big, complicated sounding property terms, we're here to help you. Think of this video as your bar cheat sheet to all the difficult property terms. Simple definitions, quick examples, and a few moments where you'll realize that you might know a bit more than you think. So with that, let's get started.
So, you been well?
I've been good, thanks. How have you been?
Yeah, very good. Bit of a cold, but it's going away.
You've had that for a long time now.
Not a long time, just a couple of weeks. But yeah, it's the weather.
Weeks is a long time.
Just the weather, under the weather. But I'm feeling way better today.
And the weather's nice today too.
Beautiful day outside, and quite sunny and bright. Been having rain over the last couple of days.
Yeah, the last 2 days.
We always need the rain.
Not when I'm outside though. I was outside and I got drenched.
Yeah.
Yeah.
Anyway, so this is our 9th episode now.
Something like that.
So, which is quite good. And how are you finding it so far?
I'm finding it good.
Enjoying it? Learning anything new?
I'm learning lots of things new. Every episode I'm learning more terms, more things around investing, strategies that I've never even thought of to think about. So yeah.
Okay. And with your friends, I'm sure they've seen you around in social media, presenting and all that. Have they given you any feedback on how they are finding your content, if ever they are listening to it?
No, the ones that have seen it think it's good. That they're learning lots. Yeah.
Good. That's
What about you? Have your friends said anything about it?
pretty much, yes. So, we're getting a word of encouragement out there to say we're giving value, we're giving out value, we're giving out, good education, and we would like to continue to do it that way. So to everyone who's listening today, there's actually more to come, and please stay tuned.
That's exciting.
It is.
So before we start defining any major terms, let me give you a quick summary of what we're going to be talking about today. Today, we'll be covering 5 major topics or umbrellas that these complicated sounding property terms are normally under. The first being money and lending basics. These would include terms such as LVR, LMI, fixed or variables. The second topic, buying and legal steps. This will include things like stamp duty, conveyancing, contracts, and settlements. The third is performance and tax. Yield, cash flow, depreciation, negative and positive gearing. And the fourth, strategy and lingo. Rentvesting, refinancing, split loans, and equity plays. And finally, the fifth umbrella we'll be covering is market and location terms. This will include terms such as vacancy rates, demographics, zoning, and gentrification. So, our first topic, money and lending basics. Dad, can you help explain this to me like I'm 15 years old again? Are you ready?
100%.
So let's start.
Let's get it. Let's get started.
This might sound like an easy one, and one that most people think they know, but deposit.
Deposit. So deposit on a house or on a place for you to live in is the cash money that you need to come up with to cover the initial deposit. And then you will be borrowing the rest as a loan. So it's basically the cash money that you come up with for you to buy a property. So for example, if you're buying a $500,000 property and you put $100,000, then you've put in a deposit of 20%.
Can you help us define what the word leverage means in property terms?
Sure. So to leverage is to use other people's money or the bank money for you to buy a property. For example, if you are putting in 20% deposits to buy a $500,000 property, then it's what we call 5 times leverage. So you're buying a bigger asset by only putting a smaller deposit.
I've never heard of this one, so I'm assuming others maybe haven't. But what's LVR, or loan to value ratio?
So LVR, or loan to value ratio, is the percentage of the loan amount to the value of the property. So I'm going to keep on using the example of $500,000 so that it's easier for our listeners. In this case, if you have got $400,000 loan and you're buying a property worth $500,000, then the LVR is 80%. So 400,000 divided by 500,000 times 100%. So that's 80%.
And we've discussed this next one a few times actually, and I was stuck on it a few episodes back. But what's LMI?
LMI, or lender's mortgage insurance, is a fee or an amount that you pay to the bank if you are borrowing more than 80%. And it's on a scaling gradient. Let's say you're borrowing 95%, then you'll be paying a higher LMI compared to, say, someone who's borrowing 85%. And this fee, or this money that you're paying to the bank, is basically to protect the bank and not yourself.
And building off of LMI, what's LMI capitalization?
This is when the LMI is put on top of your loan for you to pay it over time instead of paying it upfront.
I think I might be able to answer this next one. Interest, which is the fee to borrow money.
That's it. Simply the fee to borrow money, or the cost of borrowing, in other words.
And how about interest only?
Interest only. What do you think interest only is, Thabo?
It sounds self-explanatory. You pay only interest.
Interest only, yes, it explains itself. It's only for a limited time though. It's not for the rest of your loan. So for a limited time, you're able to pay interest only, and this will enable you to pay lower repayments on your loan. And then opposite of that is principal and interest. So this is when you'll be paying the interest in addition to the principal as well. And it enables you to reduce the loan amount over time. However, the monthly payments or the regular payments that you'll be paying will be higher than in an interest-only loan.
And on this topic of interest that we seem to be on, how about a fixed interest rate?
Fixed interest rate. What do you think it is?
A fixed interest rate. You have a fixed rate of interest that you pay that is on your loan, perhaps?
So in other words, yes, you're right. You lock in a rate of interest on your loan over a period of time. For example, in today's markets, you can have a fixed interest rate of, let's say, 6% over 2 years. So it means over a period of 2 years' time, you've fixed your rate to 6%. If interest rates go up or down, then you will be paying that fixed rate interest of 6%. So this interest rate, or this fixed interest rate, is normally a good strategy to fix it if you think that the rates are going to go up, because you're locking in right now. If you feel, or if you think that the rates are going down, then it's not a good idea to fix, because you're fixing it over time, and when they start to go down, then you'll still be paying a higher interest.
So maybe for a situation where it goes down, maybe a variable interest rate might be better off.
That's right. And a variable rate, or a variable interest rate, it's more flexible. It means that it changes as the Reserve Bank changes the interest rates as well. So where does it help, or where does it apply, or where is it more useful? It's more useful to have a variable interest rate when there's a stronger sentiment, or when you think that interest rates are going to go down.
And can you help us define what a split loan is?
Yes, so a split loan is where you can actually have a combination of fixed rate and variable rate at the same time. So for example, let's say you've got a $400,000 loan, you can have $200,000 as variable and the other $200,000 on a fixed rate as a combination.
I've always heard you use this word, but I've never really fully understood what it means. Refinancing.
So refinancing is simply replacing your existing loan with a newer one in order for you to, say, access some equity from that loan, or even change terms, like change the loan term or interest rate. And this can actually be done through the same lender or a different lender completely. And most people will refinance, mostly if there's to do with when they want to find a bank that's providing them with a lower rate, or in some cases when they want to access equity to buy, let's say, another property. This could be an investment property, or they're upgrading their own occupier house.
What about debt consolidation?
What do you think debt consolidation is? Can you give it a shot?
Would it be rolling multiple debts into one loan to try and reduce interest, perhaps?
Correct. Yes, correct. So you are taking different little debts that you might have, putting it into one. And this is mainly done in order for you to reduce the repayments or to reduce the interest on that. And it's useful if you are trying to preserve your cash flow or to free up your cash flow so that perhaps you can actually go out and buy other assets or other investments out there.
I've actually never heard this one before, and it's family guarantee or guarantor.
So this is when a family member uses their on home equity to guarantee you on your loan so that you can come up with your deposit for you to buy a house or a property. This is mainly done if we're trying to avoid lender's mortgage insurance or increase your borrowing capacity. For example, you want to get into the property market and you don't have a deposit. So you can come to mom and dad and say, look, I want to get into the property market, but I don't have any deposit. So we can be guarantors on that loan, where we use our home equity to put down as a deposit so that you're able to buy your first home. And then that way, that can give you a deposit to get into the property market, or even avoid you or make you avoid paying lender's mortgage insurance, or even providing you with a higher borrowing capacity as well.
Can you help us define what conditional approval is?
So a conditional approval on a loan is when the bank says, yes, we are going to give you a loan. However, these are the certain conditions that you need to meet before we can finally approve this loan. So there are some certain conditions that are attached to the loan that they've approved for you.
And on the contrary to that, unconditional approval.
Unconditional simply means, yes, here is your loan that we have given you, and there are any conditions that are now attached to that.
What about repayment holiday?
A repayment holiday is a temporary break or reduction in repayments that you can apply through the bank to not pay your loan or to repay your loan over a period of time. Usually you will need the bank to approve this bank holiday, depending on your circumstances.
This one's a bit of a mouthful, but cross-collateralization.
So cross-collateralization is when one loan is secured by multiple properties or multiple assets. Or multiple properties. This really is protecting the bank in case you default on one loan, then they have got all these other properties to actually have a security on that loan. It provides a lot of inflexibility, and to most of our clients out there, we always recommend against this structure of a loan.
You've mentioned this word a few times before, but equity.
Correct. So equity is simply the value of your property minus any amount of money that you owe on it. So let's say, for example, your property is worth 600,000 and you owe 400,000. So your equity is simply 600,000 minus 400,000, which is 200,000. And this equity, you can tap into it to, for example, put as a deposit on another property.
And like with interest, we have a few umbrella terms under equity, like negative equity and instant equity. Can you help us define those two?
So negative equity is simply when your loan is more than the value of your property. It doesn't usually happen, but it can happen, for example, in a declining market where you buy a property today and let's say, in a few months it drops in value. So you can have a situation where whatever you're left owing to the bank is now more than the value of the property. And then instant equity, this is when the equity is created in a quicker way, where, for example, you've gotten yourself a good property deal. And this is as a result of usually buying below market value, or you've actually bought a property that you've done a renovation and you've created some equity in that. So you're creating what we call instant equity.
Let's reuse a quick example that you did before. The house price is $500,000. Our deposit was $100,000 and our loan is $400,000. Talk us through some of the new terms that we just learned.
That's right. So the LVR or loan to value ratio, according to example, is 400,000 divided by 500,000 times 100. And that's 80%. As far as leverage is concerned, that's a 5 times leverage because you managed to buy an asset or a property of 500,000 when you only have cash deposit of 100,000.
So that was just the money and lending basic terms, but let's move on to the buying and legal steps.
Sure.
The paperwork process stuff. Dad, go.
What's your first term that you have for me?
Stamp duty.
Stamp duty. So this is the amount of tax that you pay to the state government at the purchase of your property. And the stamp duty varies state by state, and sometimes it changes whether you're a first home buyer, you're an investor, or you're even a foreign investor as well.
What about the term conveyancing?
So conveyancing is the legal side of buying and selling of your property. A conveyancer or a solicitor handles searches, checks, and settlement paperwork to make sure that everything is done in a legal way. Very, very important for you to engage a solicitor or a conveyancer because they are able to break down all the legal terms that are associated with buying and selling and also explaining your rights as well during that process.
This term sounds like it involves a few more pieces of paperwork, but contract of sale.
So contract of sale is the legal document that spells out all the legal terms that are associated with you buying or selling a property. And this contract of sale must be signed by both the seller and the buyer of the property to make it enforceable.
I've never heard this one, but title search?
Title search. So title search is normally done by the conveyancer or the solicitor, and they want to make sure that they are confirming the legal ownership of the property that is being sold or that is being bought, and whether there are any issues on that property. For example, caveats, easements, or any other legal issues.
If someone asks for an appraisal, what does that mean?
Normally this is done by a real estate agent providing their opinion on the value of the property. This is different from a bank valuation because it's being done by a real estate agent usually.
Let's say I'm looking to buy a new house and I want a pre-purchase report. What is that? So
pre-purchase reports don't only pertain to new house, they can also be an existing house that you're buying. And these are very important reports that look at the pest and build inspection of your property to make sure that it's part of the due diligence. You're making sure that you're buying a sound and good property that doesn't have any defects or any insects or termite infestation.
What is meant by the word zoning?
This is the council's rules about what the land can be used for. For example, can it be used for residential or commercial or even both?
Could you please explain what the words body corporate or strata mean?
This is usually applicable to units or townhouses, whereby it's a set of fee that is paid by all the homeowners of that complex for the money that is available for the maintenance of common areas, like swimming pools, gardens, elevators, and things like that.
On realestate.com, when I see the term private sale, what are they talking about?
So this is when a property is sold without an auction. Usually this is with negotiation.
This is one often heard a lot. Settlement.
Settlement day is very, very exciting and sometimes nerve-breaking for people buying and selling out there. But this is the day when the property officially exchange hands from the seller to the buyer. And this is also when it exchange ownership as well as exchanging money as well from the buyer to the seller.
This one sounds a bit self-explanatory, but owner-occupier?
What do you think owner-occupier is?
When the owner lives in the property.
That's right.
And how about a property manager?
A property manager is a professional who handles tenants, rent, inspections, and maintenance. They charge a fee for their work, usually between 6 to sometimes 9%. And I tell you, this fee is worth paying because they do a hell lot of work behind the scenes to make sure that your property is managed properly with the tenants.
So now we're on to our third segment, and that is performance and tax. So let's break down some of the big terms that people often hear that have to do with either performance or tax with their property. This is the does this deal work section. Our first term is capital growth.
This is simply the increase in value of your property over time. In capital cities like Sydney, Melbourne, maybe Brisbane and Perth, this capital growth usually averages around 6 to 7% per annum. And if you buy right in a good market, this capital growth can make your investment double, let's say every 10 to 12 years. There's a rule of thumb in real estate that a good property should actually double in value every 10 to 12 years.
I've often heard this one, but can you help us define rental yield?
Yes, this is the formula to calculate your rent as a percentage, and it's calculated as your annual rent divided by the value of the property times 100. Normally, yields nationwide, they kind of average between, let's say, 3.5% to sometimes about 6.5% to 7%, depending on the location of where you have bought your property.
Now let's talk about cash flow, gross versus net. Can you help us define the differences and what are gross cash flow and net cash flow?
So when we talk about gross cash flow, we're talking about just the gross rent that you're receiving on your property. However, the net cash flow is now taking care of the total rent from tenants, take away all the expenses on your property, like property management fees, council rates, maintenance, insurance, and other associated costs.
And what about a cash flow deficit?
This is when your expenses on that property are higher than the rent that you're receiving. Sometimes we call it the rental loss, where you're not receiving, or the rent that you're receiving is less than the expenses on that property.
And you've used this term a lot, positive cash flow.
This is when the rent covers all the expenses on the property and you're left with some money in your pocket.
Sticking to the theme of cash flow, can you help us define the terms before and after tax cash flow?
So simply, before tax is just the net cash flow before tax. Net cash flow after tax is simply when we have taken care of all the tax deductions that you're eligible for, that we're going to discuss a little bit later on.
Later on is now.
Oh yeah, that's right.
Tax deduction.
Correct.
What's a tax deduction?
So these are costs that you claim for running or holding your property, and they include things like interests that you pay to the bank on the money that you have borrowed, any repairs that you do on the property, any expenses like council rates, and even travel expenses when you go to repair your property. And the whole idea is to make sure that you are keeping all the records so that you can substantiate all those expenses come tax time.
And what about the term depreciation?
Depreciation is a non-cash tax deduction item that you apply on your property for the wear and tear of the building itself, as well as any fixtures like carpet, curtains, window coverings, stoves, and other inclusions in your property.
So with that definition, what is meant by a depreciation schedule?
So this is a report that is usually prepared by the quantity surveyor that stipulates what you can legally claim year by year on your property.
So here's another two for you. Negative and positive gearing.
So this is when your property is making a taxable loss, which can reduce your other taxable income as well. And on the other hand, a positive gearing is when your property makes a taxable profit. So negative gearing is a good strategy that our investors use. They are on a high income tax bracket. And when they're on a high income tax bracket, they're paying a lot of tax, and they can use negative gearing to offset that high income. And it's usually something that can be used as a good strategy. On the other hand, positive gearing works better probably for those investors that might not be on a higher tax bracket, but also probably for those clients that are wanting or that are needing the rent to sustain or to supplement their day-to-day income as well. So we can use both strategies for different types of clients depending on what we are trying to achieve at the end of the day. When we are building a portfolio for our clients, sometimes we can use a combination of the two, particularly when we are trying to build a portfolio over a sustainable period of time.
And last but not least, what is meant by the terms median house value or median weekly rent?
So this is simply the middle price or rent in a suburb. It helps us with benchmarks to sort of see, when we're entering into a market, the value of what we are paying, where does it lie compared to the average sales of that property, which you call the median house price or the median rent.
Do you have any more examples for us today?
Yes, we'll do a bit of some math. So let's say on our property that we have bought for $500,000, we are going to receive rent of $550 a week. 550 times 52 weeks in a year, that gives us $28,600. So our gross yield is $28,600 divided by 500,000, which will give us 5.72%. If our expenses on that property are $24,000 per annum, then our net cash flow is $4,600 per year. If that $500,000 property grows by an average of 5% per annum for 10 years, then the value would be $814,447. So the capital growth is $314,447. And that is what we call compounding at work.
What is compounding or compound interest then?
This is the application of your capital growth when it's adding on to another capital growth and another capital growth. So you are, in essence, you are receiving profit on profit on profit over a long time. And that's how it enables properties in good locations that are bought well to pretty much double every 10 to 12 years.
With that, that's the end of segment 3. But let's move on to segment 4, strategy lingo. Buzzwords people throw around all the time but never really define. Let's translate them. Rentvesting.
So this is where you rent where you want to live and you invest where the numbers make sense. Mostly, you might be wanting to live in a suburb or in a place for lifestyle reasons. Say young people nowadays can live in Bondi, let's say, because you want the lifestyle. However, you want to get into the property market, but you can't afford to buy a place in Bondi. So what you do is you can now invest in a place like Newcastle, where you can afford to invest where the numbers work for you. So you are still getting into the property market as an investor in Newcastle. However, you are still happy to live in Bondi for lifestyle reasons.
I've never heard this one before, but what's debt recycling?
Yeah, so usually we use this strategy to convert non-tax deductible debt. For example, on the loan of the house that you live in, into tax deductible debt, like debt on investment property. Mainly to reduce your taxable income by making sure that you're converting bad debt into good debt.
There used to be TV shows on this next term all the time on TV when I was a kid, but what about the term flipping?
So this is when you buy a property and you add value through renovations and then quickly sell it for a profit. I should tell you this is a higher risk strategy because of the short amount of period where you're trying to make a profit. So sometimes, property goes up and down. Imagine if you're buying now and then you renovate, but the market dips a bit, then you might actually be forced to sell at a loss or to hold it for a little bit longer for you to actually be able to make a profit later on.
Could you also define the terms distressed sale or mortgage sale?
So this is when the seller and usually the bank will need to sell quickly as a result of the house owner not being managing to pay off their loan repayments, or there can be a situation in or a circumstance in a family, for example, death or disability of the mortgage holder. And sometimes these sales can be below market value.
I've heard this term a lot actually, but I've never researched into what it actually means. So what does foreclosure mean?
Very similar to the term that I just mentioned before, but this is when a bank takes back possession of a property and they will sell it themselves due to non-payment of the mortgage or the loan repayments back to the bank. So the bank will basically take ownership and say, yep, we hold security of the asset and we're now forcing you to sell. And usually these sales are done via an auction.
Could you please explain the difference between a commercial and residential property?
So commercial properties are usually properties that business owners run their business from. And these include offices, shops, and warehouses. They often provide a higher rental yield and less outgoings, but they have different risks associated with them. On the other hand, residential property is property that is bought so that people can live in, families can live in on a day-to-day basis.
What's the difference between joint tenancy and tenancy in common?
So this is to do with the ownership structure of your property. Joint tenancy is where two people or more own the property in equal share. If one person passes away, then the surviving person owns 100% of the property. On the other hand, tenancy in common is when you hold different percentages of that property, and you also control where your share goes as well.
This is the fifth and final segment, market and location terms. The where and when language. Vacancy rate.
What do you think it is? Vacancy rate.
The percentage of rentals sitting empty.
Correct. So I think in our previous episode we spoke about vacancy rate. As an investor, are you looking at a place where there's a higher vacancy rate or lower vacancy rate?
I would want to look at somewhere where there's a lower vacancy rate.
Correct. And the national average at the moment in Australia, vacancy rate is about 3%.
Oh, wow.
Yeah. So if you are an investor, check out that important number, vacancy rate, because anything below 3% is good, and anything higher than 3% might give you problems by finding tenants for your property.
So kind of going into that, how about defining the word demographics?
Demographics basically defines who lives in the property. We're looking at the demographic structure of, for example, the general population of that area, the age group, whether they're retirees, whether they're students, as well as their income bracket as well. And this is a fundamental factor to look into when you're investing, because you're trying to see what caliber of renters you attract in your investment.
This one's always thrown around in the news and in papers. Property boom or property bust.
So property boom or property bust is the rapid rise or rapid decline of the property values in the market. And for most investors and clients, we advise them not to time the booms and the busts, because property is for the long term, but not to time these booms and busts. And with the right strategy, we are able to map your growth of your portfolio over time in a more sustainable way.
Could you define the term gentrification?
This is when suburbs improve as new people move in, cafes pop up, school upgrades, and demand grows as well. In other words, it's an improvement of a general feel of a suburb. And when you do your homework properly, you want to invest in older suburbs that are actually experiencing this gentrification.
In line with improvements, define the term infill developments.
So these are new buildings in established suburbs where there can be some spaces or gaps where you can build homes or even townhouses or apartments, and these buildings or these new establishments are in an existing suburb.
You defined what conveyancing is in a prior segment, but what's conveyancing searches?
So conveyancing searches are usually done by the conveyancer or the solicitor, and they'll be searching things like titles, council, flood, easements, heritage, and usually to give you peace of mind so that there are no surprises when you're buying or selling a property.
All right, Dad, give me 3 rules for beginners.
Know your numbers, yield, cash flow, and buffers. Know your lending, LVR, interest only versus principal and interest, fixed versus variable rates, and loan approval stages. Know your team, broker, property mentor, conveyancer or solicitor, building and pest inspector, and property manager.
And what about some 3 red flags?
So buying without an inspection, that's a no-no. Over leveraging with no cash buffers, that's suicide. And cross-collateralizing everything without thinking about the downside events.
So after going through defining and explaining all of those must-know property terms, here's your back to basics action plan for this week. Pick 5 terms from today's episode that you weren't 100% sure on. Then write each word and define them in your own words. Then run 1 real listings numbers: price, rent, gross yield, rough costs, and net cash flow.
Property investing isn't about sounding smart. It's about making the smart moves. Use this glossary of terms. Keep it simple and build steadily.
If this helped, give us a follow and share it with someone who you think needs help defining a few of these hard or misunderstood property terms. For tailored guidance, head to yourwealthmentor.com.au and book a complimentary discovery call. Sip smart, invest better, and we'll see you guys next week.